Hey, hey, hey. Welcome to Let's Just Invest Part 1. Over the next few minutes, I will provide you with some quick tidbits that will hopefully help you start building wealth in the stock market. I've put this presentation together to help anyone who is new to investing in the market and just not sure how or where to begin. I will begin by telling you who I am, why I am doing this, and who it is for. I will also be providing you 3 investing terms that I believe will help you understand how money can work for you instead of you working for money. I will then specify 3 things to help you select those stocks without banging your head into the desk during the process. And finally, we will go over the steps to get you going and also prepare you for part 2. All right, on with the show. So for the first who, that would be me. Just a regular guy wanting to empower you to participate in the stock market. I know there are a lot of mixed feelings about investing, and my aim is to take some of the hassle out of that process. There's plenty of money to be made, and there's enough for everyone to go around, so why not get your slice of the pie already? The first why for me putting this together is I've never received much help from past employers and advisors on what to invest in. I've heard many blanket statements, I've heard the shoulda, coulda, woulda stories, but nothing useful to actually make a decision. Now, I understand no one wants to be liable for recommending something to someone that ends up losing them some of all or all of their money, but if you're here to advise me, can I at least get something to work with, right? So from mutual funds, 401ks to IRAs, I just never knew where to start. In part 2, we will be exploring some of those alternative accounts to help you find a good place to park your earnings. Another reason I came up with this presentation is because of what's happening in the world right now in reference to the COVID-19 virus and the panic that it has caused in our daily lives and in the stock market. The panic caused a crash just a few months ago, and I'm hoping that some of you were able to take advantage of the opportunities that were presented. I know market crashes and corrections are considered bad to some investors, but it can also be a good thing for others. The virus started to affect the world from the end of the first quarter through what is now still the second quarter of this year. I believe as earning reports start to trickle out next month, more panic will cause another drop, and I want you to be ready. Now, the second who is none other than you. I want you to not only know that you can afford to invest, but there are also ways to guard against losses by making sound decisions. Now, this doesn't mean that you will not take any losses at all, but these steps will help you decrease those chances. Now I present you with 3 investing terms that I feel are important to know and understand as you become an investor. Understanding these terms will help you to see how money can work for you instead of you working for money. I will break these terms down for you, but I didn't write them out on the slide because I want you to get used to doing a little bit of research when looking up stock information. So yes, you do have a little bit of work to do, but we call that your due diligence. Take some time to look these terms up and become more familiar with them after the presentation. Our first term is going to be capital gains. Capital gains are when you make profits when the share of your stock price goes up. So let's say you buy a share for $10 today, and next week the price of that same stock is now $12. You have earned $2 in capital gains. Very simple concept here. The price of that stock will fluctuate up and down, but of course we are aiming to buy it at a good low price, so the majority of the time that you hold the stock, it will go up. You probably have heard folks say buy low and sell high. This is a concept that means by buying stock when it's at a low share price, as the stock recovers to a higher price, you then have the option to sell it at a higher price to keep the increase of those capital gains. Our second term is dividends. Now, dividends are your friends. Now, dividends are payments made to you, the shareholder, by a company that you bought your shares from. It is basically a company saying, thank you for believing and investing in us. So here, take some money and please keep believing and investing in us. Dividends are paid per share. So if you have 5 shares of a stock, you will get 5 times the amount of that dividend. So if a stock is paying, let's say 30 cents per share, you would get a cash payment of 150 on payout day for those 5 shares that you have. Dividends are paid monthly, quarterly, and annually, but most companies pay quarterly. Now, the best thing about dividends is that they are paid regardless if the share price goes up or down. So even if your capital gains aren't working very much for you, you can still count on the dividend payment to increase your account value. I'll take that all day, and I'm sure you will too. Now, our third term for today is compound interest. This is not necessarily specific to investing, but can be of use when you're selecting savings accounts if you decide to withdraw your profits from your investment account and decide to place them in another interest earning vehicle like a high yield savings account. We will discuss different types of accounts in more detail in part 2. Albert Einstein called compound interest the eighth wonder of the world, and I tend to agree with him. So let's say you have $100 in your high yield savings account that pays you 1% interest every month. At the end of January, you now have $101 being paid at that 1%. So you now begin February with $101 and will now earn 1% on that new balance. So at the end of February, you will have earned $1.01. Now, after we add that to the current balance, we now have a total of $102.01 to start the month of March with, and so on and so forth. So even though the interest rate of 1% doesn't change, your account balance will continue to increase after each monthly payment. This is another plan I can definitely get with. Now, with the combination of one or all of these factors, they can significantly increase the profits with little to no effort. I mean, you're actually getting paid to do nothing except leave your money alone. And I don't know about you, but that's an awesome deal for me. To the good stuff. The first thing I want to share with you is the CCC Spreadsheet. Go ahead and pause the video and download if you want to follow along. Now, this is a vast spreadsheet, but don't get too discombobulated about that just yet. We will only be looking at one tab and a few columns today. What you will find on this spreadsheet is a list of companies that not only pay dividends, but have also raised the dividend for the amount of years shown in the spreadsheet. CCC stands for Champions, Contenders, and Challengers. Your champions have raised their dividends for 25 or more years, the contenders have raised their dividends from 10 to 24 years, and the challengers have been raising their divvies somewhere between 5 and 9 years. Now, this collection is just simply amazing to me, and once you get familiar with it, I think you will tend to agree. You can probably tell by now that I like to invest in dividend-paying companies, and I like it even more when they decide to pay me more and more as the years go by. This list was originally created by a man named David Fish, rest in peace to him, and it's now maintained by Justin Law. Bless them both. One important thing to remember about this spreadsheet is that it is updated monthly, so make sure you download the latest copy when you're ready to start your research. Okay, we have our spreadsheets open. Let's look at the bottom and go to the CCC tab. After clicking on that, let's look at column I. Now, this shows you the price per share for each company. Now, I start with this column first because I like to choose an investment depending on how much money I have to invest at the time. If we look at the example at the bottom of the slide, we will see that one share of stock from Bank of America will cost me $24.12. So if I want 3 shares of this stock, my total investment will be $72.36. So if I only have $75 to invest this time, this might be a good choice for me. This is where you can decide on which stocks to purchase based on your budget. Now, if we look at column E, this is how to tell if a company is a champion, contender, or challenger. Again, champions have raised their dividends 25 or more years, the contenders have raised their dividends between 10 and 24 years, and challengers have been raising their divvies somewhere between 5 and 9 years. The general idea here is that the more years a company has raised their dividend, the more stable the company is. Of course, that is not always the case, but it is a very, very good indicator. Columns K and J will come in handy if you want a specific percentage or amount of payout when you earn on your investment. Now, some more due diligence will come into play here once you have decided on which companies to go with, but there will be plenty of time for that a little bit later. Now, if we look back at column B, you will find the ticker symbol for each company. This is what is used to look up a particular stock when doing your research. As we see below, the ticker for the Clorox company is CLX. When perusing investment sites, you will notice that the company name and the ticker symbol is used interchangeably. Now, one more caveat to go with this spreadsheet is you'll see some verbiage or numbers showing up in red. This usually means that something has happened with the dividend. Remember that this is a collection of companies that not only pay a dividend, but also raises them. So a number in red can mean that the company has recently cut the dividend, meaning instead of paying 30 cents, it now pays 25 cents per share. Or the company may have frozen the dividend, meaning that instead of raising this dividend to 35 cents, they're just going to leave it at 30 cents. Now, as I mentioned earlier, COVID-19 has caused a lot of companies to make decisions that are best to keep their company in business. So a red number doesn't necessarily mean that a company has bad business practices all of a sudden or are in trouble financially. What it does mean, however, is that you will need to do what? And that's right. You need to do some more of that handy dandy due diligence before purchasing a stock from that company. And also, just because a company has cut or frozen the dividend doesn't mean they won't raise it again in the future post COVID-19. Okay, now this slide was chock full of information to take in, but I have plenty of confidence that you will get it in no time. Now, my next tidbit for you today is the PE ratio. Now, this is an indicator used by many savvy investors to determine a company's value. This slide is self-explanatory, but let's go over it quickly. The price earnings ratio, the definition here, is also known as the PE ratio, PE, or PER. Now, that is the ratio of a company's share price to a company's earnings per share. This ratio is used for valuing companies to find out if we think they are overvalued or undervalued. Now, a PE ratio of 20 and below are ideal. I would not recommend buying anything over 21 unless it was just an awesome company that we knew was going to do well in the years to come, but that is also kind of difficult to determine. Now, the preference of 15 and below is very, very good. We said 20 and below, but if you can find something 15 and below, I would definitely consider purchasing that stock. You always want to avoid a negative ratio because that's showing that the company is way, way overvalued and you don't want to get into that boat. Now, the ratio will fluctuate with share price, and you always want to calculate that when you're ready to invest. All right, ladies and gentlemen, we're almost at the finish line. Hang in there with me. We have the third tidbit of information for you today by way of the 52-week low share price. Now, this price indicates that at some point in the last 365 days, this was the lowest price that the share dropped to. Now, ideally, buying shares at or around this price would have fared very well for an investor. Now that COVID has already caused a crash in the market in the past few months, and we can see cases increase around the globe daily, I don't believe it's done having an impact on the stock market. In fact, I believe that the earnings reports from the second quarter, which is April 1 through June 30, will start trickling out next month in July and cause another wave of panic and thereby causing another drop in the market in the coming weeks and months. Should the market take another dive, that will be the perfect time for you to start investing in stocks while they're down and allow you to ride those capital gains back up as the market recovers. So if we look at the 52-week number, chances are that price was set a few months ago, which is just another reason to take a look at these stocks that you're interested in and keep an eye on them over the coming weeks. Now, the share price correlates directly to dividend amount and yield percentage. So if you want to invest for a specific amount of payoffs, this is where you want to pay attention, because the lower the share price, the higher the dividend percentage is going to be. Now, purchasing near this 52-week low price usually renders great returns. However, don't miss out on a good company over a few dollars. The price may not drop all the way down to this 52-week low price again, but you have capital gains and dividends to make up those profits if you happen to buy at a price above that 52-week mark. So now we're at the next steps. So the next steps, I want you to go ahead and download that CCC Spreadsheet if you haven't already and select 3 companies that you want to research based on your budget and price range. Now you're going to use the ticker symbol from column B to find the PE ratio and the 52-week low information when researching. This can usually be found on a summary tab on any of the sites that you might be researching. And here are a couple of sites that I like to use. Yahoo Finance is very, very good for overall information and comparing to similar companies that might be competing with the stock you're looking at. The CNBC app is a great app for looking up a company real quick and creating a watch list very, very easily. So this is very good. I keep this one handy just when I want to look at something very, very quickly. Now, my favorite site is Seeking Alpha. This is excellent for the articles, and please do not skip the comment sections. These articles are written, and in the comments you have people who are agreeing or disagreeing, and they're formulating a lot of information that can be very, very helpful when you're going to invest. Now, the next step is I want you to create a watch list on one of the platforms that we just mentioned so that you can monitor the choices that you've made. The 3 choices that you made, the 3 companies that you've decided to pick, go ahead and track those 3 choices over the next several days just to see how they react to the overall market. This is the point where we're going to start getting used to seeing how a stock is correlating to the overall market or any news that might be going on in the world. All right. And I also want you to subscribe to my channel so you can get notified when part 2 becomes available. Also, as I had mentioned before, we will be discussing different accounts to where you can park your earnings and interest and stuff once you start making money off this market. And in that part, I will also provide you a fourth indicator for choosing a good stock during that presentation. Okay, well, that completes my presentation for part one. I hope I have provided you with some useful information to get you started on your path to building wealth. I want to thank you for tuning in. Everyone be safe and let's just invest.